Hello, welcome to Strictly Money at the News Farm, where all voices matter. I'm your host, Saijal Patel. If you're like most people, you probably enjoy shopping online from the comfort of your home. And if you do, you will have noticed a different way to pay for your items. That is paying in installments using a third-party vendor. Buy now, pay later services have grown in popularity over the past few years. In fact, BNPLs are expected to grow more than 50% annually to close to $17 billion US by 2028. Joining me now to discuss the rise in popularity of BNPLs and what consumers need to be aware of is Doretta Thompson. She is the financial literacy leader with CPA Canada. Doretta, thanks for joining me.
My pleasure.
So I know the concept of paying by installments is nothing new, but this use of BNPLs have really exploded. I mean, even banks are trying to get in on this. Why do you think we've had this huge rise in its popularity?
I think that there are a few things that are driving the trend to this. One is just how easy it is. The digitization of buy now, pay later. As you said, it's not new. This has been around for a very long time. It sort of starts way, way, way back with the old layaway plans. The difference, of course, is that under layaway, you made your major payments every week or every month, but you didn't get what you were purchasing until you had paid for it. This, of course, you get and you pay in the future. Digitization has speeded everything up. And one of the key changes is that it's now available for almost any purchase, including very small discretionary purchases. And it is so easy to do. It's just like a click of the button. These are tiny, think of them as little tiny unsecured loans, micro loans, if you like, that are so easy to do. And people just love that.
Yeah, Doretta, I mean, you mentioned the layaway plan, right? And you always have this concept of that, zero down, no interest for a period of time as well, typically used for white goods or furniture. I know lots of people who have taken advantage of that. Can you explain then how BNPLs work exactly?
Yep. So basically, they're a point of purchase loan. So which means that as you are buying them, you get the loan right there. But they are not secured, generally speaking. The approval process is it's very different from, say, a bank loan where you have a credit check and things like that. And generally, one of the most popular models is something that they call pay in four, which is very popular for these small purchases. And then you pay it over 4 installments. Generally, what happens is you make the first installment when you buy it, and then the other 3 you will make at say monthly intervals or whatever it is. There are a number of different providers. They all have their own little rules and regulations. So you want to be sure you understand what it is that you're getting into. But basically, that's how it works. And it's interest-free as long as you make every payment on time. And that's the caveat, as long as you make every payment on time.
Yeah, and I think we have a board of some of the popular ones. You know, there's PayBright, there's Saijal, Klarna is another one, and obviously there's so many more that are coming on as well. You know what I think is really interesting too, Doretta, is from a retailer's point of view and why they would do it. Because typically, from my understanding, is they're the ones who pay a surcharge or some sort of interest, depending on, of course, the terms. And I think the thinking around with retailers is that they get better conversions. I myself, this is really interesting because I'm struggling with this. I offer a financial literacy program, and yet my customers are asking for this type of payment plan, which is kind of ironic because I'm trying to teach them, good financial skills, and yet I want them in the program so I could actually teach them these things. Yeah, what's your take on, at least from the retailer's point of view, what's happening?
I think it's very interesting. I actually spent a little bit of time looking at the websites of these service providers, how they pitch them to retailers, and they pitch them to retailers on ease and on increase. Basically, you will increase your sales, and they, some of them will have claims of up to 60, 75% in a year or whatever, because what you're doing is you're removing the friction in the sales process, right? And for small businesses, small retails who can't hope to compete with larger, big companies, maybe this offers them, really an advantage and ability to compete on a level playing field, with it. And so typically what happens is that it obviously will be vary from provider to provider, and on the particular service that you choose, that agreement that the vendor chooses to enter into.